We have 4 panelists that are eager and ready to share some knowledge and answer, or maybe dodge, some uncomfortable questions. You can already start thinking about what you, as founders, as builders, would like to ask VCs, because usually it's the other way around. Because at the end, I'm going to open the stage for audience questions. And if you have something in mind that you are always afraid to ask during the pitching hours, I suppose this is the environment that you can ask that.
It's payback time.
Hey. So with no further ado, I'm very glad to welcome you all at the early stage rounds tips and good practices panel with our VC guests over here. My name is Marcin. I'm one of the co-founders of Redstone Oracles, but also one of the co-founders of ETHWarsaw, like this event, and I'm very pleased to have such a noble group over here sitting next to me. So we have truly diverse pack over here. The guys are investing anything between $100,000 to sometimes even $3 million, or maybe even more, depending whether it's bear or bull market, right, guys? They also feel it. So I would like to kick off with a short introduction from each of you. So maybe Sjors from Lemniscap, maybe you can start.
Yeah, sure. So yeah, my name is Sjors. I'm part of Lemniscap. So Lemniscap is an early stage blockchain and crypto VC firm. We've been around for some time. We started late 2017. I joined the firm pretty much since the beginning. We are quite generalists in what we are deploying in the space, so we are not narrowing down to one particular vertical. And what I'm doing day to day at Lemniscap is taking care of all the technical stuff. So my involvement comes to doing technical due diligence, jumping on calls with founders, as well as post-fundraise, actively participating in the portfolio projects that we are investing in. So that's a little bit about myself.
Yeah, can you hear me well? Yeah. Hi all, Martin, thanks for having us, much appreciated. I'm investor at Market One Capital, early stage VC coming from Warsaw. We have under management 140 million euros, currently investing from 80 million euros fund. Tickets up to 2 million euros preferred lead or call it position, and we invest in Web 2 and Web 3. Maybe I will see time of Web 4. Let's feel still fairly young, and we focus on network effects, right? And this is our kind of main narrative for anything Web 3 related, is that the natural evolution of network effects is is in blockchain, and that's pretty much it. Yeah. Sorry.
Perfect. I'm going to echo my colleague, and before introducing myself, I want to thank Marcin and the amazing ETHWarsaw organizers for having us. I'm Blake. I'm the Partner Program Director at Outlier Ventures. Outlier Ventures is remote first, but London-based. We've been investing in first crypto, then Web3 since 2013. So in many ways, we are the OGs of the space. But since 2019, our primary business model is operating accelerators. We're aspiring to be the Y Combinator of the Web3 space. Since then, we've been running multiple programs with different partners focused on different verticals, from luxury fashion to infrastructure to DeFi to zero knowledge, you name it, we have it, as long as it's tied to Web3 or the wider concept of the metaverse as an operating system. And since then, we became the biggest investor in Web3 by the deal count. Currently, we have 257 projects in the portfolio, and I had the pleasure of running 4 accelerators with Outlier Ventures, 2 of them Filecoin Basecamps with Protocol Labs, and 2 of them with the Farfetch group focused on using Web3 technology in luxury fashion. So it's a great pleasure to be here today.
Hi everyone, my name is Michał. I'm representing Arca today, where I lead venture strategies. We are one of what you would call multi-strategy asset manager in the space. Primarily, the strategies today that we are best known for is our liquid fund called Digital Asset Fund that has been a flagship, actively trading these markets since 2018, primarily in liquid tokens. Then in October 21, we launched our venture strategies, which I lead, and then with our sister NFT fund launched the following year, we kind of comprise a group spanning all the markets, whether they're liquid, private, and everything in between. Again, super excited to be here. I'm returning to Warsaw thanks to our wonderful organizers who just make it impossible to stay away. And once again, wanted to give huge shout out to ETHWarsaw team, and very excited to see what comes out of this hackathon. In the past, we actually did make free investments, and myself wrote an angel check from last year's edition. So super keen to see what comes out here.
Nice. It's really good to host you guys and see you for the next time, like in the coming years as well. So one thing I'm especially proud having this panel is also having like 3 Polish-speaking people. It's yours. Maybe you're going to learn yours as well.
I will try my best.
Yeah, but all of these guys are investing internationally. So it's not that they are Polish-speaking and they're just close for this region. It's truly like global scale investing. So that's amazing to have such guests over here. All right, so now let's go to the first question, the true one. So imagine I'm a founder and I'm pitching you right now. My team won a major prize at ETHWarsaw Hackathon, and we have people registering on our waitlist already. When should I think about my first pre-seed round or maybe angel round? And what traction should I show for the first investment? Who wants to pick first?
I'm happy to kick off. I would say try to build as much as you can without seeking funding, just so the product is at a satisfactory stage to pass the due diligence, and try to keep your runway lean and mean. For traction, my sweet spot is actually just some traction, doesn't have to be much, but what's important for me is that it validates your business model. If it's a, let's say, B2B setup, that would be clients. If it's infrastructure, that would be developers adoption. But then I know the architecture makes sense. It takes away a whole layer of risk for me as an investor. And of course, I think that goes without saying that I would love to see that there is a complete team and everybody on the team is incentivized to stick with it long term. And I think alignment of incentives is something I'm going to bring up a lot in this panel. So just want to apologize in advance for repeating myself.
Yeah, I think it's interesting what you're saying, but I mean, a project that's coming straight out of a hackathon, I mean, how much like product market fit can you already expect, right? Like usually this is, just like someone that wants to be a founder or like a group of developers that, want to take it to the next stage. So usually how we are approaching it at Lemniscap is, just having like conversations with the founder, like trying to grasp like, okay, what is the future vision of the product that this founder or founders want to bring alive, and then based on that, basically making our investment decision. Because when we were talking about pre-seed, you can't really expect like any traction there, right? Like it's just a founder with an idea, with a vision that he or she wants to bring alive. So that's kind of how we are approaching pre-seed. When we are talking about, maybe like a seed round or a little bit later, obviously it will be great to, like have a little bit of traction or at least product market fit. So that's basically how we are looking and assessing things at Lemniscap.
For me, I think if you're just out after hackathon, I think you should be talking actually to as many VCs as possible, right? Because you might have tech talent, you might have business development skills, whatnot. But I think it's quite niche to have fundraising skills and to be able to understand the VC ecosystem, right? And ultimately, this is brute reality that you need to fundraise from some entity. Obviously, there are cases of bootstrap companies that are super big, but I think vast majority of companies, whether this is Facebook, Google, or whatnot, they were built with VC money, right? So if you want to play this game, you need to learn what are the rules of this game, right? And you can learn the rules of this game by talking to actors in this game, right? Or NPCs in this game, right? So if you talk to, and then I think the skill is to filter what to listen to versus what to ignore, right? So that's how I would approach it.
To kind of round off some of the responses that we heard from the panelists, I firmly think of the early stage investing as people's business first. While you might be fixated on particular product and technology that you're trying to underwrite and wrap your mind around as an investor, fundamentally I'm looking at a team. Is the team complete? Are they in it? Is the heart really in it? As many of you know, hackathons are a lot of fun. they're also addictive. We often talk to hackathon participants that travel the world all year round, hacking away, without necessarily maybe committing to one project for a while. And it is a real commitment that I think we are looking for founders that are taking it to their heart. And their subsequent ability to convince others to follow along on this journey is tremendously important. So I think judging by kind of the charisma, the way they are presenting themselves, and the rest of the team is probably one of the first key criteria. The second one, unequivocally, is storytelling. Once again, many of us here come with a set of our biases, our own kind of mental frameworks about this market, about crypto at large. And it is incredibly important for convincing and compelling founders that we have come across in the past to really outline, help us connect the dots, and tell the story about the product, the type of audience, really hitting on some of the key points in order for you to kind of construct that message that lands quite well and eventually could potentially convert to having us cut the check at the end of the process.
Plus one to what Michał just said. I mean, it's a surprise that this is coming from a person based in US. Compelling narrative is ultimate. I mean, there's a very nice saying from Don Valentine, original gangster of VC, founder of Sequoia, that building a startup is a function of money flows as a function of storytelling, right? And I think that's just kind of strengthening what Michał mentioned in this area.
That was his Polish part, I suppose. That was talking, not the American one. Before we continue, let me ask, who is taking part in the hackathon this week? And please raise your hand. All right, so I would assume it's like 50% of the audience. So guys, on Sunday, if any of you win any prize, chase these people. I mean, like, you have the whole right to chase them and then materialize what they've just said, right?
Or we will chase you. I mean, that could be as well, right?
Yeah, it could be as well, right? So then run away. I mean, the more you run away from the VCs, the more they like you, right? I was fundraising runs, and sometimes it's true, actually, right? Okay, since we have a couple of more questions, I would like to move to the next one, which is, in my opinion, super important for people who will be structuring their fundraise soon. So, again, sorry for a question, but let me ask, who has ever done a fundraising from the audience already? Please raise your hand. Okay, quite a few, more than I would expect. But token rounds were a standard in 2021 and the first half of 2022 in crypto. But for the past year, early stage founders have scratched their heads around the tokens versus equity versus mixed structures of the deal. What's VC's preference now in that regard? Where do you see it moving? And what tips do you have for founders how to navigate it as it is for today?
I can jump here since our fund is Registered Investment Advisor. That little acronym means that we are reporting to Uncle Gary at SEC. And as many can appreciate, there is such a thing as precedent and precedent setting in at least the common law of US in and around what actually constitutes as a viable investment contract. And so as of recent, this is really just last 2 months, with the summary judgment in the Ripple case, and why so much of crypto Twitter and pundits all over the world were talking about it, is that very summary judgment has had tremendous implications for investors such as myself with a vehicle based onshore in the United States. And that is what used to be a very common practice, and our fund really was set with an extremely flexible mandate to both do the traditional safe agreements, so with convertible notes for equity, all the way to essentially token warrants and mix of the two in between. With that Ripple summary judgment, essentially that token warrant that used to be a very standard practice is now really called in question as potentially being deemed as a security, unregistered security offering, which would put me in a crosshairs and potentially us as a fiduciaries at looking at a jail time if it came to that. So as you can probably appreciate where I'm going with this. Today, we are very much open to discussing with all the founders that are currently structuring their offerings and trying to do it in an as compliant manner as we can, given kind of the guidance. What that means in practice, we'll definitely do a convertible note, but rather than a token warrant, which used to be kind of done in the past, more of a boilerplate, we will definitely go down the route of having a token rights agreement. And for anyone with questions with regards to that, happy to give you some opinions. Again, not a lawyer. I should have read a proper disclaimer here at the outset, not an investment advice, do your own research. But that is definitely a consideration that's bleeding into the day-to-day of deal structuring for us.
Yeah, maybe for like funds that operate outside of the US, I would like to maybe add some perspective there. Like we have quite a flexible approach there. So what matters for us and what has always been the case is like the model needs to fit basically the stage of the startup where it's fundraising in, right? So, I mean, we have seen way too many projects that have been, like doing a token offering for the sake of having the token and being like liquid very early on. I mean, if that's the sole purpose of doing like a token fundraise or fundraise in tokens, it's definitely something that, I mean, we wouldn't invest in. So, yeah, basically bottom line, what is most important for us is that the structure that a startup is planning to raise in needs to make sense for the product that they are developing, right? And a lot of times, especially in like early stage stuff that we are looking at, like the tokenomics or like a token model is not clear, right? Like it's not clear how the product will evolve to something where a token could be incorporated. And then we are basically going back to the structure where like a lot of startups are planning to raise initially or some of their initial rounds in equity with then a convertible note, so a token warrant. So that maybe later on, if they are ready and if there is going to be a token, that basically the equity can be converted then into the token that they are planning to launch. So that's kind of how we are looking at things and are approaching which model makes sense for startup.
Very glad that I'm not reporting to Gary, but a disclaimer is a good idea, so not financial advice. At Outlier Ventures, we usually seek double exposure, both to equity and token, simply because at the very early stage, you might not really know if the token ambition will play out the way you want it to. Broader in the market, we have seen investors, and for our portfolio projects raising, we have seen investors kind of drifting away from a simple agreement for future tokens and kind of flock to equity, even the investors that previously had a strong preference for tokens, and essentially engaging in a safe with a token warrant, simple agreement for future equity with a token side letter that gives you a degree of exposure to token proportional to your equity holding. In terms of advice, there is a big asterisk here that you really have to think, and you touched on it very well, you have to think about where the value accrues in your business model. Because if you're offering me equity, but all the value of your business model accrues to the token network, that equity essentially isn't worth much. So that's a bit of a clause, some soul searching that you need to do before you pick the right instrument. And finally, also remember that usually a simple agreement for future tokens has a specified date by which you need to launch the network. Otherwise, you might have to give some money back. And in uncertain market conditions, this is a big commitment to have a date signed on paper for a network launch.
I would approach the question from the perspective that you don't need a token and try to satisfy the question, what's the utility for end customer to have a token, right? I think token proved to be foremost speculative instrument. Obviously, I'm biased. I invest only in equity, so that's kind of might be a bit bitter about tokens. But ultimately, you see plenty of companies with tokens where the token need is fairly unclear, right? And I think it might serve for virality, as a go-to-market strategy to drive adoption, but most time than not, it proves to be fairly empty adoption, right? So if you can survive without tokens, do this first, and then if there is a need for actual token with actual need satisfaction, then think about tokens.
Yeah, so My summary for this, all of the speeches is going to be from autopsy. So I was raising my funds, and what I remember, no one wants to jail. No one wants to go to the jail, right? So everyone is a bit afraid, like how to structure that, and is playing sometimes on a thin ice. And one advice I would give to any founder that considers fundraising in the future: start learning about these structures already. Start learning what's safe, what's soft, like what kind of incorporations are viable. Ask yourself why we don't have that many crypto startups incorporated in Poland. Understand why. Because there are reasons for that, right? So the earlier you start learning about that, the less of a surprise it is for you when you're thinking about product, you're thinking about customers, you're thinking already about this money that you're going to make as a company, and then you get in your face your first SAFT, which is like 8 pages, and then you have to read it for the first time, and you're like, whoa, 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 I'm not signing up for that, right? So be ready for that when you start talking with VCs. I would say from my autopsy, I can already tell you from the hindsight, I wasn't that much aware how much it differs from traditional equity startups, usually like in Web 2, right? But going forward in the conversation, like you, Source, mentioned very important factor when it comes to only token deals, which is liquidity. When you have a token, usually it's way easier to simply dump it at one point when it's open in the market and it's liquid. So imagine a startup doing only token rounds and now closing the second raise, seed, let's call it. What cliff and vesting should apply to founders, the pre-seed investors, so the previous investors, and seed investors, the current ones? How would you approach that topic?
Yeah, I would say, I mean, usually the founders have the longest lock in the round, and that's simply because they need to carry the project and the startup forward, right? So usually that's what we are seeing. That's how we are helping basically, startups that we are lead investor in, like structuring their rounds as well. So that's definitely something important there. Then with regards to, you know, maybe like a treasury fund, like maybe some ecosystem funds, and then obviously the VC investors, they obviously come after that. How that's usually structured, I mean, maybe from like a VC perspective, like what we are seeing these days is that usually it's like a 1-year cliff with then like a 1 or 2 year like linear unlock. So either then monthly or quarterly, you have like some tokens that are unlocked. And a lot of times, like the startups are having like some sort of incentivized like mechanism, whether it's like staking, whether it's like participating in governance, which will reward basically like large or small token holders into the project as well to basically keep it fluctuating in there, right? With regards to, you know, how we as a VC then are, you know, like exiting maybe some of our position, I mean, that always goes into collaboration with the portfolio project and really depends on the market cycles that we are in, right? Like if we are, for example, looking at like the current market conditions that we are in, I mean, let's be honest, it's still not where we would like to see it. I'm not sure if it will, you know, like catch up like anytime soon with that regard as well. So for us as a VC, there's no reason to, you know, now sell anything because we are kind of waiting for the market to uptrend. And if we are there in, like, let's say a new cycle, then it's the time to basically start discussing with our portfolio projects, like where's our vesting, and then whatever has been unlocked and is liquid in our fund. We are then obviously like creating a strategy around, what we want to exit, which portion, but that's always in collaboration with, you know, the startup or portfolio project itself in that sense. So.
Very sound logic. And just to maybe plug some numbers in there, just based on the best practices we're seeing in the market, thanks to the scale of Outlier Ventures and the fact that we're kind of everywhere. Again, as you said, the founders need to be incentivized for the long term to stick with it. So I would say roughly 36 months vesting schedule with a 12-month cliff. Pre-seed investor, I would be expecting something around 24 months vesting schedule, maybe 6 months cliff. And then for a seed investor, respectively, 18 months vesting, 6 months cliff. A question that often comes up is also advisors. So advisors are somewhere in between in terms of that incentives alignment. So for advisors, I would say 24 months vesting schedule, 12 months cliff, much like the founders.
Very specific, but nice. I like
No, that's good. I mean, very specific is also good because at the end of the day, understand, guys, you have to put a date, right? And then there is a date, and then you pray that someone will not dump. Or
You make it sound like D-Day. I mean, that's...
Yeah, for some projects, it has been the D-Day, right? You guys know it. Like, you can look on the CoinMarketCap or whatever on the charts, and the story is like written over there, right? So I really like being very specific as well, so that you already start plotting in your head, okay, then happened this, I have this much time, and so on. This guy can dump then, we'll see what's going to happen, because it's not that everyone jumps all the time.
But again, not financial advice, just good rules of thumb. Sorry.
Yeah, no, I think with us, it really depends who at the firm you ask that very question, and this is probably one of the trigger questions during our investment committees. Our Chief Investment Officer, Jeff's answer to this very question is no lockups, immediately straight to the market. Why? Because he's a liquidity operator and a trading maven. He wants the markets to set effectively the most efficient way to price the projects. That's why we don't let Jeff run our venture strategy.
He's the dumper of the firm, or like...
He is, liquidity maxi. I think that's how you would describe it. And so there is this fundamental tension, and tension that I think as a founder, as a builder in the space, you have to recognize. Another element to, I think, the figures that Błażej has just quoted, that Outlier is keeping a wonderful database of, is that they are actually a moving target, and they're responding to where are we in the cycle and in the market. Some of the numbers and kind of the cliffs guidance that you've heard might not have been there, say 24, 12, 18 even months ago. We had some very significant events in the space that sometimes we don't like to talk about much, but they not only led to some valuation reset, but also stretch out of certain norms. So I would almost posit that for a lot of the US-specific based projects, we are seeing almost a return to kind of the golden Silicon Valley standards, really mapping onto kind of the 4 years vesting with that 1 year cliff being kind of like the new normal. But then again, it is very much like a moving target based on where we are in the cycle. And for us, the one element that every team should absolutely consider, it will draw out a very different type of investor to your round. So what I think Marcin was also alluding to during probably Redstone's conversations, there is almost a distinctly world of two speeds in the fundraising. Those investors that fundamentally will lead off with kind of an equity type of round and see tokens as an optionality, and others that will actually very much push for token and kind of some immediate or at least medium term, which I think in crypto means like, 3 months, 6 months, liquidity. And that's the element that I want the founders that are beginning their fundraising journey to be extremely sensitive and aware of. Because the different kind of investor you'll get early on will have significant implications on your later rounds. And especially in the bear market that we are at right now, we are working through several workaround solutions where we are actually converting a lot of these token raises into equity. Because even the founders are like, well, I cannot manage that liquid token while I'm still figuring out my product market fit.
Yeah, so I mean, ultimately what you're looking for, right? I think you should be looking for alignment between funders and investors, right? And taking an analogy of Web2 and Golden Star in Silicon Valley, the vesting tends to be 4, sometimes 5 years, right? And that's being redone with every round, right? It's getting extended with every new investor. I think that's also something to remember, that if you raise seed and you have 5 years vesting, and when you raise Series B, you still might have 5 years or 4 years or something like this of vesting, right? It's not that with 5 years you are done with vesting. It depends on your most recent lead investor, really, right? So this is first rule of thumb, right? Alignment, and I think the more the merrier when it comes to both vesting period and the lockup period, right?
Nice. Thanks a lot, guys, for this. For me, like one of the bottom lines that I also try to remember is the founders are the last. the founders are the last to cash out because someone has to keep building the project, right? Like there are already projects out there mature enough so that founders can already, materialize some of their gains from creating the project. But remember that it's rather a very long time from the beginning, like from the moment you start a startup until the moment you see, let's say, the fiat money out of your equity. It's a very long time. But here, let me ask the guys the question that they are not prepared for, so that it's a bit more spicy. So you touched upon a really important point, which is bull and bear market and liquidity of various bodies on the market as well. Tell me about one investment of yours or your fund that you did the most cash out of. Not that you're the most proud, because at the end of the day, VCs have to make money, right? It's not that they are charity organizations. Tell me about the one that you made the most cash out of.
We are still young VCs, so no comment. No, I mean, look, I think it's a skill to leverage bull markets to exit, even if you see that everything is up and right? And in next year it might be the double devaluation, because at certain point the music stops, right? Whether this is crypto, tech sector, or whatnot, it tends to be it's cyclical, right? I think we had a lot of lessons, good ones and bad ones, from market one. With some deals we should exit much earlier. I won't name them, but our major allocations, and with the other ones that we should stick to, we exited too early, right? And I think that's how you can see a very mature VC. It's when this person understands cycle and is able to not look for the high, but through the kind of what this person is able to get paid, and if they deliver money to LPs. This is ultimate goal of VCs. Deliver 3+X on money invested from certain fund.
Yeah, maybe to add to that, I mean, it's extremely difficult, whether you are like a VC firm or like a trader or whatever, to basically time or exactly sell at the top, or making sure that you are not like exiting at the bottom, right? So, I mean, obviously, and that doesn't matter like how experienced you are, like if as a VC firm, I mean, it's just extremely difficult to time basically your exits. But that comes also to my point where, I would emphasize like timing is everything there, right? Which means that right now in the current bear market that we are in, I mean, people have been saying this on Twitter or on X, on however you want to call it, like that, right now we are truly in a builder's market, which means that now is basically the time, if you're planning as a founder to bring basically your idea to market, now is the time to basically prepare for that, right? Now is the time to create your MVP, to put your first like fundraise round together, because basically we as VCs and you guys as, potential new founders are basically preparing for the next cycle. When that will happen, nobody knows, right? Like, can be 1 year out, can be 2 years out, but that it eventually will happen and the markets will, catch up again. I mean, I'm a firm believer that that's a given. To come back to your question, like, what was the most profitable investment of Lemniscap? Like, obviously, it's very hard to, put names out there, but we have been doing, I would say, extremely well on investing into some of the layer one platforms. Like basically anything that has like an ecosystem tied to it is generally doing very, very good in the market. And the reason for that is that these layer ones are like launching a token, and this token is basically being utilized by the entire ecosystem that's building on top of, for example, these layer one platforms. So a little bit more generic, no specific names, but vertical wise, like that's definitely good. As you can see,
this Sofa is very good at dodging this question, right?
Exactly. I mean, I was a little bit more specific.
No, that's correct. That's correct.
I can see these two guys right now, like Neo from Matrix, like doing this kind of like dodging the bullets. Let's see how the other part will do about the question.
I'll jump in. I don't think it's particularly secret. We've been pretty public about it. We had a great fortune, still, I would characterize as such, to discover Sky Mavis very early on, even before they actually launched a little known game called Axie Infinity that to many could be attributed to kind of the rise of the blockchain gaming and the saga that kind of followed. Launch of Ron in net and the kind of all the adjacent properties that are currently built out there. So as such, we have entered this investment extremely early on, engaged with the whole Jiho and the whole team from the earliest days of them going through very complex act of navigating and changing tokenomics when the game is live. If you want to talk about it on the side, this is a saga and many sleepless nights for us as a team, trying to patch this one up. But certainly, we were very open with that team about the nature of our vehicle that we have invested out of, and kind of the liquidity obligations that we had out of that vehicle. That was also one of the reasons that particular investment that was originally warehoused inside of our liquid hedge fund, why we have launched this private market strategy. There's a lot more aligned with essentially longer-term holding periods. Today, and I think Michał was alluding to this a little bit, we are all running venture firms. So there is a very real business behind it that we just kind of wanted to demystify it. When you look at any fund represented here on the bench, the life cycle of your deployment window when you're writing the checks, typically between 2 to 3 years on that time horizon. And then you have about 7 years plus maybe 3 years of extension, let's call it 10 years of period to harvest that particular fund and return your funds to the investor. Now, with that little math, what you are realizing is after you have deployed most of your fund into the market, there is going to be a big responsibility of you to being able to take the money off the table. And I know it's oftentimes frowned upon. There's a lot of crypto Twitter chatter about it, but that is just the nature of doing business. So you might as well, if you're not necessarily ready or prepared for that kind of relationship, kind of transactional, no matter what, you might want to bootstrap for a little bit longer. And but that is kind of like the price of essentially getting that early injection of a capital in your journey. Nothing is free. So any risk-free investments out there, like be very cautious. There is always price.
No free lunch outside of ETHWarsaw. So I'm not sure if this is an example of like the biggest cash out, because we still hold a lot of those tokens, but I think it circles back to the theme that we discussed of timing. And this is an example of the perfect timing. So when we launched the very first Basecamp, the first edition of our accelerator, we brought in Justin Bannon, the founder of Boson Protocol, the distributed commerce protocol. And essentially, Justin have been the best example of a builder, somebody who's obsessed with solving the problem, and you know, even if you didn't support him with a single pence, he would still build it without you, which is always a very good sign. And we supported Justin in the middle of the bear market. And frankly, he just built like crazy, and then when the token went live, suddenly the bull run hit. And we could like take some of our money off the table. And I'm still very impressed to this day, because the other day we were trying to write a research paper about distributed commerce. And we started scouting for different established definitions online. And it turned out there is only one established definition, and this is by Justin Bannon and Boson Protocol. So definitely, when we're in difficult market conditions right now, I really believe this is a builder's market. And I would love to repeat the success case of Justin Bannon, who just built through the bear and then made it big in the bull.
Nice, thanks guys for sharing, Sam. I mean, I know it's not a comfortable question, but the reason I ask that is to show that VCs, you have to understand them. Like one, of course, they are there for money, right? It's like they have to make a profit, but these are also very experienced guys that try to navigate the founders on the waves of the market, like bear market, bull market, the token structure. Very interesting part is also like renegotiating the contract. So you signed something, for example, during the bull market, now it's a bear market, so you have to come to your investor and say, yeah, you know, on the terms that we did like half a year ago, I'm not going to make it anymore. And then you have to renegotiate, right? So these are very interesting dynamics that all the founders should also be aware of. Okay, so we have 20 more minutes, and I would like to go to one of the parts of the title of the whole panel. So what are the most common mistakes from early stage founders that you observe? Do you have any tips for these founders to raise their first pre-seed or seed later?
I think it's really about being able to explain your vision and the product that you want to build with the startup that you're raising for, like in an understandable way for whichever VC you're talking for, right? Like
so this is the moment you take notes, guys.
No, so it's like how I'm seeing it is that we are seeing way too often like a very technically sophisticated founder that's, for example, not very good in like communication. For us, it's not necessarily a deal breaker. So I want to put that out there, but we see that way too often, and a lot of VCs are then either not understanding what this person is trying to build, or basically communicating across. And for us, it's also could be an issue because, for example, if this founder wants to bring its product to market, you need to be able to sell it, right? Like technology by itself is not going to gain adoption and is not going to basically gain market share for you. You need to sell once your product is out there to like a broader audience. So then we are stepping in and then advising at that point if the product is interesting enough, we still might write a check, but then advising to maybe look for a co-founder who is better into basically presenting the vision of the product. When we are talking specifically about mistakes, I think, one of the questions or one of the main points that we assess when we are having conversations like early on with a founder is like how married is this founder to its idea, and what is his or her willingness to pivot and to adjust basically based on market feedback or based on feedback from the first users in the MVP. Because what we like to see is that if a product like early stage doesn't get any traction after like an X amount of time, we would like to see this founder pivot to something else. We would like to see this project to experiment around and try different things instead of really being married to the initial idea. And I think that's definitely something that we value a lot. And it's hard. I understand if you are a founder and you have spent like so many months on building something and researching on your product to completely sometimes shift like 180 degrees into a different direction. It's hard, right? It's like your baby in the end. But the willingness and the capabilities of doing that is, I think, a very strong strength for a founder and an early stage startup in that sense.
I really like that you made the point around communication skills, because I think it translates beyond fundraising. It's also sales, it's also hiring. And if they're not strong communicators, why would people kind of bet on them and follow their vision beyond just investors? In terms of maybe the common mistake and then the reverse of it, advice that would be a different approach, do not just go out raising a made-up high number that you took from the top of your mind. The goal of those first early fundraising rounds, as much as we want you to become rich as a founder, the goal of those first rounds is not to make you rich, it's to get you enough runway so you can deliver enough milestones to actually fundraise again and fundraise successfully. So always don't think about how much I want to raise, think about what milestones I need to deliver on the product front, traction front, hiring front, how much money I need for that, how much runway I need for that, and then calculate it back from then. Don't just try to, especially in the current market, don't try to shoot for the highest valuation possible because you found some bull market comparable and you want to like get a high valuation. First of all, in the current investors market, I wouldn't say high valuation close quickly. And there are other smart funders out there who will lower their valuation just to get money on the table, maybe less money just to control dilution. And then they will essentially take your spot in that portfolio while you're just entertaining some super high valuation numbers that are not fit to the market dynamics.
Big fan of simple and simplicity. I think kind of the favorite framework there is KISS. Keep it simple, stupid. Really the moment you're pitching and trying to tell your story, what is the product, what are you trying to do, take a pause, take a deep breath, and try to really think of the shortest way that you can essentially relay your great vision and ambition. I know this is probably one of the toughest exercises for anyone that is writing in kind of the syntax of a code. You're trying to equally, some of the best programmers in the field are trying to be really laser focus on optimizing on the efficiency. As little lines of code as possible, allows with greater audit, allows for much better kind of scrutiny, and honestly, functioning these open source environments, you get a lot more feedback on. Almost the same equivalent advice I would translate to a VC pitch. You want to be not kind of all over the place. You really want to come across as focused. And if there are any follow-up questions, leave it for after versus trying to kind of get it up front, especially in your decks that we have seen many that are just very hard for me at the end of a pitch to understand what your product is, where you're going to land your mark. So try to help me visualize it and kind of keep it simple for me on kind of the reception. The point that Błażej just mentioned, I think you're really in kind of the expectations management business to yourselves as a founder, to some of your employees, but also eventually if you take one of us on board to your investors. And I would rather have a founder that is being well-rooted, well-grounded in kind of the expectations and the reality of this market versus someone that perhaps overshoots in that early fundraising journey and sets themselves really unrealistic, lofty goals that they can't crush and smash it. Especially in the very early days, I see too many founders that want a lot more ownership, that don't want to kind of particularly partake in this co-creating act, which oftentimes is how we are thinking of participating in your rounds. So that's probably just some of the hot takes that come top of my mind.
I mean, a couple of points from my perspective. So the first one, I will be just repeating after all of you guys. The art and craft of storytelling, this is not something that you can discount. And I think, especially in our region, that's an issue, right? We struggle with selling. I think many of us think that we oversell, that it's kind of not elegant. And in US, they don't care, right? They sell every day. And I think if we can learn anything from US ecosystem, whether this is Web 2, Web 3, or whatever market, is the ability to sell on a daily basis, everything, right? So this is point number one. Point number two, I think founders struggle or are too optimistic about navigating through market. And very often you see that they don't understand their positioning, they don't understand their forces, or forces dictated by the market. And this is quite simple omission, right? This is not something that you need to craft for years. This is simple, maybe not simple, but this is market research, right? And this can help you long term, right? If you understand, why certain schemes or platforms are in use and why there is nothing newly developed. Maybe because of distribution, network effects, whatnot. I think this ultimately helps you with your business and with your product and distribution, right? Which leads me to the third point, is that ultimately business is product and distribution. And everything else is negligible, especially in the first days. And distribution will always trumpet product. Obviously, product can help you with distribution because if you have 10x product, it's just much simpler to distribute, right? But distribution is ultimately will always trumpet product from my point of view. And I had a fourth point, now I forgot it. Just give me a sec. We can get back to it.
So you come to Michał later and ask for the fourth point that is like the mystery for us right now. Okay, and then another surprise for you guys. This one super quick as we don't have much time. I'm raising my first pre-seed. You have to give me the range of the valuation. Please do. No matter the product, like what's the lowest that you would invest and what's the highest in the first round?
I mean, from the fourth point, sorry.
No. Give me the number.
Okay. So ultimately, you have a function of time and valuation, from my point of view, right? And you want to reach equilibrium of enough time spent on fundraising and not focusing on product or distribution versus valuation, right? And you're in the market that you don't need to find consensus on the demand side. You're looking for one demand side actor that can lead the round, right? So you can optimize for this, and you should probably optimize for this, but I would say, especially in early stages, optimize for time versus for valuation, right? For me, I mean, the latest guidance from YC, I think, is to not raise above 20 million post-money for YC companies, which tend to be overpriced.
Can you repeat the number?
20 million post-money valuation US dollars.
That's top. And low?
I mean, 1-2 million, that's low.
Okay, who else?
But Marcin, you got to give us like a little bit more here. Right? Is there a sector or sector agnostic?
I mean, like, there's probably a certain low valuation that it doesn't make sense to invest, right? I mean, as a VC, like.
Sure, I'll throw in. I'll give you say 1.2 on 6 money post, which for those that accurately kind of study the trends in VC is a lot more than Brian Chesky got when he got his first valuation when Airbnb was valued at the measly $5 million. So yeah, I'm a big believer of you, Marcin. So that's my starting bid. I'm not going to 20. Sorry.
I mean, yeah, it really depends, right? It depends on the vertical, it depends on the product. But I would say, like, if we are really talking about like pre-seed, like 5 to 20 post, like, so yeah, kind of agree with you. A little bit higher on the lower end, but yeah.
Yeah, you can see he's not coming from the region, right?
Yeah.
So I would say, at the pre-seed stage, again, dilution is kind of something you need to be mindful of. So probably you shouldn't be relinquishing more than 10% of your company. 15% is already like super risky territory, especially so early. So let's say if you're raising 1.5 at 15 posts, that's okay. If it's getting to 20, probably I would pass on it.
It depends.
It depends, right? There is always exceptions to the rule. And when it comes to the minimum, the question I would be asking myself, okay, so let's say you're raising, how much are you raising? Let's say you're raising 500K and then your valuation is 2 million. So you're selling pretty much like all of your stake that you have to sell. So that's how I would think about the lower end valuations. Of course, for us, it's always better economics. But if it means that if you raise sufficient money to build and it dilutes you in a way that you won't be able to get fundraising later, then it doesn't serve anybody.
But this is Marcin. He might never raise again.
Hopefully.
Yeah, so as you can see, the guests are very pleasant for me myself as well. No, like I really like to put them in some uncomfortable questions, but now maybe we can go to the questions from the audience. Does anyone have a question? There's a question, there's the second one. 5 minutes left, yes. And then goes the mic.
Hi. What are the unspoken deal breakers / red flags when a founder pitches you their projects? I want to emphasize on the unspoken ones because, yeah.
I mean, what is really like something that is a huge red flag is like a founder that's shilling returns. So someone that's like, saying like, oh, this is gonna be your next 50x, or this is gonna be your next 30x. It's like, it just doesn't do it for us. It doesn't add any value to the table as well. So I would definitely say, like, if we are having a call or a pitch deck where this is in there, then we are like, okay, this is not for us.
Gotcha.
Yeah, couple of buzzwords come to mind. Risk-free, infinitely scalable. What else we got? I mean, there's a lot of buzzwords. So for me, actually, the greater concentration of buzzwords, the less confidence I have. And I will push more for actually how deeply the founder understands. That's probably kind of my litmus test.
With every cycle, you have different buzzwords, right? And I think when you DD the company, when you in the due diligence process with a certain company, I mean, sometimes you kind of observe that the founder is not full-time in this business. This is very no-go. If there is 1% of doing something else and it's not helping your grandmother, this is red flag for us. If there's any side hustle for a founder, this is very clear red flag. So that's one thing. Second one, and quite often, especially quite common, especially in the region, is the broken cap table. When you have some advisor early on, that's for 20–30%. That's just nonsensical for market standards. Yeah, those come to mind.
So I think that you're touching on the most important point, which is the ultimate red flag. And back in the day, I tried to list those red flags, and then I realized they're all one thing, actually. It's the misalignment of incentives. Any case in which there are two co-founders, but one founder is actually on a salary, and if he reaches certain milestones, then he's going to get equity. Or, there is an engineer on board, and he's not on the cap table. Turns out he's the boyfriend of one of the founders. Those things usually come back to bite. And when people are aligned to kind of shoot for different goals, in this example with a founder who's being paid a salary until he reaches certain milestones, his incentives are not aligned for the company to succeed. His incentives are to kind of sugarcoat his value and hit those milestones or pretend they will be hit, and then you're kind of in dirty territory. So again, broken cap table or any seeming misalignment of incentives. The second one would be misunderstanding or misrepresenting execution. If they're telling you they worked very hard for like 6 weeks and they decided to change the name, then yeah, it's not really execution. If they're telling you they're getting loads of likes on social media, well, likes don't pay the bills, unfortunately. So I would say these are the two major red flags, and many other smaller things you can actually pin under those umbrellas.
There's one more. Yeah.
So you all mentioned storytelling as a crucial skill. Is there any story that was so compelling that you remember to this day?
Of companies
FTX.
we invested in, or just in general?
In general.
Yeah, I can jump in, sure, which I don't often get to do because of my compliance team. One of the recent investments that we have done, we met the founders over a year ago before we actually committed to the round, but their pitch kind of stuck with me to this day, where they have very quickly hacked what you could only describe as like a human-readable blockchain. You can check it out at lorescan.com. And what was particularly compelling about that live demo is that they were able to take me as a potential newbie, really almost role play in that very role, not knowing much about blockchain, and then actually translating a pretty complex DeFi transaction right on the spot. And I just felt empowered. There was like that moment of magic, which is very hard to forget. And honestly, anyone right now in their generation striving for kind of applications to come to this space should really shoot for a moment where you just gasp for a second and you're like, wow, I won't forget that. And so we didn't make an investment back there, but we kept talking to the team, and so only committed to them recently, and they've launched last week.
Okay, I'm sorry. I'm very sorry to cut it, but I got a red flag from the organizers. But here we need to pause, unfortunately. One thing I want to tell all of you guys is that these kind of conversations usually don't have. The guys opened up and they shared a lot of things that they usually probably wouldn't. So now I would like to ask you for a very loud round of applause.